So, Malcolm, this past week, I saw something that I really think put your theory that young people just want to be seen on social media to the test.
I doubt it.
And
I'll hear you out.
granted, it was a very, there's selection bias in here, but the mayor of Denver, Mike Johnson, has been doing one of what I think is the smartest political moves for a local politician. And it's that he has offered local bars, primarily in a corridor where there's a lot of construction that has led to decreased foot traffic. He's offered bars that he will bartend for them for an evening if they want to increase business. And so a lot of bars have taken him up on this. And for people of Denver, they kind of like it because it's fun. You go to the bar, you get a drink made by your mayor. The restaurant's happy because they get more foot traffic in. And for the mayor, it's, I think, an incredibly smart thing because no one can corner him. Like, it's, if you're working behind a bar, you can go up, you can have a fun interaction with the mayor. You say hello, he makes your drink, and then he immediately has to leave to go make the next drink. And there's no rude, there's no handoff. He doesn't have to figure out any of the social dynamics. And there was one at the Denver Press Club, and it was fun. There was a lot of people there. Of the people who were running up to take photos with him, none of them were under 60. There were plenty of people there who were under 30. And
Sure.
They were having fun. They were chatting. They were enjoying the evening. It was the older generation, Malcolm. Some of them, not all of them, many of them were being respectful, that were going behind the bar, pissing off the current bartender who works there, that were grabbing selfies. And I'm not saying this is a bad thing. It's fun. He's a local celebrity. But the young people, and maybe there's some political issues here. I'm not going to get into the local political minutia of Denver right now, but there may be some political reasons for that. But I just noticed that there were cameras that were out probably for Facebook, while people around my age, a little older and a little younger, were just completely just enjoying the evening, not on their phone.
I don't think that sample set is reflective of anything other than young people could care less about who the mayor is. That's all I just heard you say. If
They went to the bar to get a drink from him, though. So clearly they want to be a part of a local political thing.
Or they wanted to say, I made my mayor pour me a shot. Like, I don't think that is this Mayor Mamdani who has the attention of the entire country at the moment? No. Is this the mayor who is sweeping up after a great tragedy hits a certain locality, and people are coming out to no. So I couldn't even tell you the mayor of Denver's name. I don't think this is really all that indicative of anything other than the point that I made to you and Alex Kantrowitz recently, that the youngs have changed the way our culture thinks about the always onness of video being taken any and everywhere you are in every space. And then the rest of the world, it ages up. Everyone else just adopts it and accepts it as a fact of life. And similar to what you're talking about, 5, 10, 15 years ago, it would have been the youngs who were annoyingly jumping behind a bar to take selfies and ruin someone else's time that they're trying to get something done. And now it's made its way up to the olds. I think you're helping to make the argument that I made on a different show about a different topic.
I'm helping. You're deciding that I'm helping the point. I have seen things. This is one other quick story, and then we'll get to the actual show, where I thought of you in terms of just like watching the young's social dynamics. I've seen it now twice at a local rec center where people are on a weight machine. If it's busy, it's so common. Hey, can I work in with you? No problem. It's a lovely part of being a part of a community. Everyone's getting healthier together. I've now seen 2 people under the age of 20 just walk up to someone on a machine and just go, hey, I was using that. Get off in the middle of a set. Yes. And in one case, some girl had some leg thing that you wrap around your ankle to like do like some sort of kick out. So it wasn't clear they were on the machine. And then the other one just goes up to another young guy and is just like, oh yeah, sorry, I was talking to my friend. I'm in the middle. I'm like using this right now. It's like, no, you're not. You didn't put down your water bottle. This is abandoned property. So there are times I am seeing sort of the social contracts completely break down between the younger generation and other people around them.
That's absurd to me. Like, I don't know. I haven't been to the gym in a while, since before the pandemic, actually. I'm sure things have changed. But I think this is the reason you get these gym fights that show up on YouTube and stuff where bros are broing down in the middle of the gym, and it's because one person just doesn't know how to act.
Well, the question is a bystander. When do you step in?
You
Because
don't.
in both of those times, not for the gym fight, but I was just like, I like talking. I like talking trash. It comes through the AirPod. I'm like, are we ready to say something? And the answer is no. We're not doing that. We're getting back to our set. If that person if that person was standing up for themselves, I think if the person was standing up for themselves a little bit and they continued to get pressed, I would be on their side. But if they just back down immediately, I can't help you if you don't help yourself a little bit.
In almost every single circumstance of life, I'm a mind your business kind of person.
I think that's probably the wise thing to do.
You know, kids, elderly folks, I might have to intervene because, like, there's a reason that I was born the size that I am. I have to take some ownership there. But most of the time, two bros broing down in the gym, not my business.
Fair enough. Let's do an actual show about testing the common financial wisdom, which is one of the promises of This Time Is Different podcast as a whole. We've got a lot to break down with saving, investing, some career stuff, but let's get going into the actual show. So Malcolm, the premise of this show is I'm going to throw some common financial wisdom, common financial truisms. We'll talk about it, but I will throw them at you and you can rate them don't rate them. Just give your thoughts on them. And then the listener can really find out if you think they are true, false, mostly false. This is a podcast where there's plenty of room for nuance. And some of this is sort of the very traditional one size fits all investing financial wisdom that you hear and see online, maybe even hear on the radio. But the first one that I think is kind of juicy is that you should save as much as possible earlier in your career. What do you think of that common piece of financial wisdom?
I think that it is great wisdom for anyone who is capable of following it. I think that whole save as much as you can as early as you possibly can. It sounds great and it technically is true. The challenge is you usually don't make a lot of money when you're 22, fresh out of college. You usually don't have a lot of earning power, period. So interestingly enough, I'm in a Uber with my wife last night and we're riding down this street that I used to live on way back when we met. And we're talking about what rent is today in DC versus back then. And it was funny because I remember saying, she was asking if I remembered what I used to pay in rent at that apartment. And this is, I don't know, more than a decade ago at this point. And I remember saying, like, the reason I knew it was time to get out of renting in DC was because I literally could not save anything anymore. So, like, as a guy who's trying to save a few dollars to buy a ring to marry this chick before she decides enough is enough, I'm out of here. Like, the thing that was really feeling like it was stopping me from being able to save in a meaningful way, what was that my rent was going up so significantly every 12 months when it was time to renew that I just had to say, forget it. I can't live in the middle of the city center anymore. I got to go out to the suburbs.
I think there is a balance. And I agree. I agree exactly with what you said, where this is good if you can do it. I've also, and I'm sure you've seen this in your office, where people get so good at saving. And there is a reverse of this that I want to talk about.
Mm-hmm.
People get so good at saving that they can't enjoy the work that they've done. They have an extraordinarily difficult time spending any of their savings to do things like travel, see family, that kind of thing. And they only get focused on the number in their bank account.
But does that happen to you in your 20s though?
No, but it can't actually. No, I think it can happen in your 20s. I think the FIRE is a wonderful movement, but there can become a system of belief that is, I need to save as much as possible. In some cases, it's because I want to create freedom for myself. That's great, a wonderful sacrifice. But then there's also it can be this belief that I hate what I'm doing so much that I want to get out of this and not really work anymore. And what I have seen is when people focus on it so much, they're not able to do things when they are young and healthy enough to do things like travel. I guess travel is the big one because you have I would say you have limited windows in your life when you can travel, which is when you're young and you're making some amount of money and you do not have young kids. When you have an amount of money, those kids have gotten older, but you're not too old that you can't make those trips anymore. And I think that those windows are a little bit smaller. So I think that one should follow an automatic savings plan and save a little bit more than they probably need to. But for a lot of people, it can get obsessive, and that's not a great thing always.
I think you nailed it with that last point. Getting in the habit of having dollars automatically transferred from one pot of money to another on a regular enough basis is probably the solve here, because then you get whatever that percentage is, 10%, 15, 20, whatever the number is, you get used to that percentage of your pay being the thing that goes into that savings bucket over and over and over at different points of your life as your income exponentially grows between like 22 and 32, hopefully. And that becomes the staple for you. But there's so many other things that happen in that era. And also that's the point of your life where nobody expects anything of you anyway, right? Like socially, as a young man, I can remember myself personally thinking about like the expectations of what you should have and what you should have going on when you approach a young woman later in your 20s or even in your 30s versus when you're 22, 23, 24. None of us has anything. So no one's expectation is that anyone has anything. I know that's not technically true because there's some people that, you know, are crypto billionaires at 19. And so they've kind of skewed what people's perception is because of Instagram. But realistically, like no one has anything and no one expects you to have anything. I also think you should be investing aggressively into growing your expertise in your career. And so anything you can spend money on that's going to help you level up your skill set is probably a better use of those dollars than them sitting in a high yield savings account. But you should also have a few dollars sitting in the high yield savings account too, because you can't repair your car with knowledge. So it's this weird, delicate balance.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
There is another issue, and this is more pervasive than people saving too much money and not, investing in their career or not enjoying life, in my view. And that's that homes have gotten so unaffordable that many people in my generation and a little bit younger have just said, you know what, I'm never going to be able to afford a home. And this is not just in the United States, this is across the world. These researchers at the University of Chicago looked into this in the US, and they've also talked about this in China and Korea. And they looked at the economic decision of what happens to someone when they say, you know what, I probably can't afford a home. And they found that they consume more relative to their wealth, they reduce their work effort, and they take on riskier investments. And they show that basically renters with relatively low wealth exhibit those patterns. And I think, Malcolm, that this is the bigger issue, which is that you now see a home is not just something that you can build up to and save toward, but something you're never going to do. So I'm going to just pay rent, and with the extra little bit of money I have, I'm going to put it in some altcoins or some like way out of the money options, some Wall Street bets types of things. And I didn't know if this was entirely true, but there is more and more research that this is in fact the case.
All right. So again, I have several thoughts about this that all compete with each other. One thing I think is this is absolutely true. We have an affordability crisis when it comes to homes in this country. partly because we just have such a significant shortage of homes. Like since 2007, 2008, when the housing market crashed, home builders slowed down the pace of building, reasonably so, 2010, 2011, 2012. And housing starts, the metric that we use to determine when new permits are filed for new home builders to throw up, new units around the country. That's the metric that tells you how many new homes are going to come into the system in the next 12 months. That number has been down since that period. And some estimates are that we're 3 million homes short. Some estimates are 5 million or more below what we actually need as far as housing stock in this country. I think that's probably very true. I also think it might not be necessary for everyone to own a home in that way. But part of the challenge is, and I say that as a person who owns a home. So let me caveat it that way, right? I might be also speaking from a place of like, I don't want to be insensitive to how hard it probably feels like it is to buy a home, right? But I also think that like it's a dream that's been sold to a lot of younger people by their parents, but their parents also aren't necessarily willing to help them make that dream come true. And so the same way, like I, as a parent of a young child who has a lot of friends who have young children, their parents are always saying, when are you going to have more kids? You guys should have more kids. We want to be grandparents. But they're also not helping. They're not offering to help manage that or help take care of the kids or help finance the taking care of the kids. Daycare is extremely expensive. It's a real crisis in this country. And so the parents who are putting pressure on their 20-somethings and 30-somethings to realize their version of the American dream haven't really recognized the fact that that takes money at a time when more than a third of my budget is going toward housing as it is. Help me help you.
It's the old line, money talks. And I think the point on the housing shortage is something that I'm still trying to wrap my head around, because there's a dark part of my brain, which is, what if that number is a little bit off? What if it takes into account that younger generations want to buy homes and raise families like older generations did? And I'm not saying that desire is not strong, but fewer people are getting married. I guess it's not want, it's just that people who are younger, fewer of them are getting married and seem to want to buy homes. Fewer of them are having children.
See, I think that might be, though, because you don't see that as an option like you started out.
Fair.
Like, I think biologically we're wired to want to cohabitate and reproduce. And so it's probably more that, like, I don't see it as a possibility, so I'm not going to get my hopes up.
And it's very much regional. I mean, among my friends in Denver, many of which are in their late 20s and have careers, almost none of them have a home. None of them have children. When I look at people in Cincinnati and Columbus, it's the complete opposite. Many of them have a home and they have children, because it's the home affordability from a regional sense is completely different in Denver and in Ohio. There's also some self-selection, I would say. And the other part of this with homes is there are new homes available. They're just 30, 40 minutes away from the city center where people want to live. And so it's the choice is, do you want to rent somewhere where it's basically the same cost of owning a home that's pretty far away from your friends and where you want to be? Or do you want to rent and be in a better area? That's
another one of those conflicting thoughts that I was mentioning that I was having. And I think it's important to point that out, because if you're saying, I really, really want this thing so bad, as long as I don't have to be uncomfortable to have it. I don't want to have to stretch too far as commute. I don't want to have to stretch too far in terms of moving to another place where housing is plentiful and maybe less expensive. I don't want to have to, like, all of it is around the idea of this wonderful, beautiful house should drop right here next to where I live currently and also be in my budget. And that part isn't necessarily realistic.
I should also say, because you said your truth, I rent. One day I would like to own a home, but right now I rent a condo in Denver. So that's part of the home affordability math going on. This is a boring piece of financial wisdom. We'll see how long we stay here. But basically, what do you think of the general rule that you should only buy a home if you plan on staying there 5 to 7 years? I think 5 sounds pretty low, but it sounds relatively reasonable to me.
I think 5 would actually be my threshold. I wouldn't be willing spend all the money on the upfront costs to get into a home if I was going to be there for less than 5 years. However, I think 5 years is probably that cliff where I feel like it would be worth it if I were there that long and then move to whatever other place.
This is a much shorter conversation than save as much as possible earlier in your career. Let's go on to this, I would say, more burgeoning economic idea. Rate it as true, untrue, mostly true, conflicting thoughts. I'll give you a hint. I'm at conflicting. And it is, I've seen this in more of the affordability think pieces. And this is a direct quote from a New York Times article that is, upward mobility is sort of dead. And that's in the United States. I think that we have agency over our own lives. However, wage growth, and I think this is an important economic detail, the traditional wisdom is that if you move jobs, you will get a raise. That's the best way to get a raise in this economy. Is you're not loyal to your job. You switch jobs once every 2 to 4 years, find your raises that way. That changed in 2025. Wage growth now for job switchers is basically the same for people who have stayed in their own job. So I think that like you do have agency over your own life, but it is impossible to ignore the macroeconomic waves that are fighting young workers.
You know what I think is going to be an interesting dynamic? I have no idea how true this is. This is more a feeling than a fact. But I am curious if the solution here is not flip-flopping back and forth between waves of working for a large corporation and then entrepreneurship, and then working for a large corporation and then entrepreneurship to get to that next level of whatever the role is that you're looking for. So you're starting off your first 3-4 years working for a giant conglomerate like IBM or something. And then in order to get that next tier of professional, that next tier of whatever in the corporation, you're going to become a consultant who consults on this very specific thing that people at IBM really need and want and love, or customers of IBM really need and want and love, for a couple of years to become known as the person who's great at that thing, and then respond to a job posting for someone who is looking to hire cross-pollination, for that thing that you now are the go-to expert for. And the reason that that's on my mind and what makes me think that that is kind of practical is because it's been my experience, both personally and vicariously, that the moment you go and hang your shingle and announce to the world on LinkedIn that you're now the head of so-and-so company doing so-and-so thing, that's where all the job offers come in. Like, where were you people when I wanted to leave the company I was at for a year or two, and I was covertly trying to navigate that behind the scenes and find where there might be an opportunity? Nobody wanted to talk to me then. Now, all of a sudden, I hang my shingle. I'm taking all these selfies showing you I'm happily self-employed, and then you want to hire me.
I think this is a personal thing going on with you, Malcolm, a little bit.
Oh, no, not me today, but like years ago, this was my experience.
I think in the world of AI, there is a debate whether you should be hyper specialized or a little bit more of a generalist. I don't know where I stand on that. And it's also something where I'll speak personally. I left a job in the summer to try to figure out what's next, and am making a career pivot, studying financial planning stuff, trying to pick up freelance work where I can. So I'm in the middle of a pivot. So for the listener, take advice from me with a grain of salt or completely dismiss it. But I think that it has never been more difficult to just build a career at one company and achieve the American dream. But the tools you have at your disposal are incredible right now. You can have, like, if not an AI agent, you can have research assistants. You can reach out to anyone in the world if you want to, and at least get a Zoom with them or talk to them. And that doesn't necessarily mean you will get a job from it. But for whatever you're doing, there are ways to get discovered and get your name out there. And I don't think that that's true just for media. So anyway, you have a thought on that?
Well, to your point about specialist versus generalist in the AI era, I think the answer is undoubtedly specialist, because the thing that's harder to disrupt is the person who's the specialist. The thing that's easier to disrupt, obviously, is the generalist who knows a little bit about a lot. But I've actually encountered a person before in my travels who is an orthopedic surgeon who only operates on left big toes. That is not an exaggeration. This guy is attached to the Cleveland Clinic system and does all of the left big toe surgeries for NFL athletes, hockey players, baseball players. Like, that's what he's known as the guy to go see. Makes a ton of money only fixing left big toes. If you got a right big toe problem, he's not your guy. AI or any other upstart surgeon is never going to be able to come unseat this doctor. That level of hyper specialization means also that he's not expected to know anything else. Like, you don't come to him and say, hey, I got this problem with my hand. What do you think I should do? He doesn't even have to respond to those questions. So it's not shocking to anybody when he says, I don't know. So if you're a generalist, though, people bring you their left hand questions, their right kidney questions, like they're expecting you to have some answer related to that because your expertise is general. So anyway, I think that very much the answer, forget AI, just in general, as a person in a professional services type of role, you gotta be specializing in something and be known for something very specific. Otherwise, you are disruptible.
I agree. The other way that you can be somewhat of a generalist, and maybe this is getting too cerebral, you can be, if you're helping people where they want a person to help them and you are hyper local, which is another way I think of fulfilling that like specialist niche. But I think that ultimately we've talked about like paths of entrepreneurship. I think for most people, it is more reasonable to solve a hyper local problem in a city than it is to build a specific AI agent that solves a widespread business issue.
Like tourists who develop altitude sickness when they visit Denver, Colorado.
I will sell them oxygen. I want you to do, we actually haven't done return on effort on the show. And I want you to talk about your idea on this, because this breaks the sort of common piece of financial wisdom that, you know, as an investor, you want to achieve the highest returns you possibly can.
Yeah, this one, you set me up with that one. I didn't know that was coming.
It's on the out. Hang on. Okay, just for the listener, real quick. Malcolm said he did not know this was coming. We operate on an outline. You know, there are things we talk about because we want to sound smart on the show. I want to sound smart. But there's numbers we're doing here. And so there's usually bullet points of what is to come. And there is a point in the outline that is on the page we're on, and it says Malcolm's return on effort idea. How did you not see this coming?
I was still looking at wage growth for job switchers. My bad. I honestly did not see that coming, like literally. However, I did recently publish something on this, so it's not like it's a thing that's not on my mind. I more so meant you threw it at me as a transition like that because you knew I was going to get fired up about it. Anyway, I feel like a lot of times investors will focus on the thing that is so wildly complicated that it feels like it has to be the best thing out there. It's got to be because this guy who used to be somebody on Wall Street who now runs commercials on CNBC and Bloomberg every single day wrote a book and has this system that he's out there selling. It's got to be great because he's selling it to people like me. The question I would ask, first of all, is if that person is so great and their system is so great, why do they want to give it to you? That's a whole other conversation. The thing that I'm focused on here is the world of private credit, the world of alternatives, the world of, you know, all these different altcoins, all of these things that require you to really spend a decent amount of time tracking them, following them. You're waking up because you get these pings in the middle of the night letting you know that something just plummeted, something just skyrocketed. Somebody on social media has said a thing about the thing that you own. Michael Burry hates Palantir, so now I got to go sell my Palantir. I got these models that I bought from this custom research outlet online. Like all these different things that amount to almost nothing more than crap that just look like a ton of activity for the sake of activity, and they drive people absolutely crazy for mediocre returns in the long run. It's a whole lot of zigzag. It's kind of like my dad used to piss my mom off all the time when he drove somewhere because he would take all these streets that connected in ways you didn't know connected, that didn't really solve a problem. Like if you had just driven straight the way that we normally do down a main thoroughfare, you either would have gotten to the same place in the same amount of time with a lot less stop and go, or you might have even gotten there faster because traffic tends to move a lot smoother on main thoroughfares. It reminds me a lot of that. And I see a lot of investors doing those kinds of things. And these are well-heeled people who make really great money, who have a lot to lose in the markets, who are doing these things that feel to me like a lot of motion and a lot of effort just for the sake of motion and effort, not necessarily generating meaningful returns.
I have a few thoughts. Number one is I'm still waiting on Citadel to sell me their trading course, which for those who don't know, Citadel is it's high frequency trading, right?
Well, you really
so
want those order flow. You don't want their class.
I'm not in. Yeah, I want their order flow. And there are people that make a ton of money from trading, but they are in offices in New York City that are very focused on what they're doing. Would love to know what they're up to. And to your point of there is an amount of effort and research that goes into trading. And I think for a lot of people who are successful in their careers, they've learned that if I put a lot of work and effort into whatever my chosen domain of expertise is, there is disproportionate rewards that follow. And in some cases with investing, that is absolutely true, but it is not as guaranteed is the wrong word, but expected as in other domains and skill sets in life, I think.
It's also a waste of your time. Like I recently was having a conversation with a friend of mine who took his Sunday to research, quote unquote, data centers being built somewhere in Italy. Or Greece, maybe he was telling me about. And he's spending 6 hours on a Sunday instead of playing with his kids, researching data center build outs in Greece. Who cares? Like buy a data center REIT, a global data center REIT that's going to include parts of Europe, and go play with your kids. Like you're going to end up in the same place, if not better, by just buying the thing that captures a wider swath of all of it. It's publicly traded. It's managed by professional investors, and it's going to save you so much time and effort.
Did he talk anything about the cost of energy in Europe?
No, but he's talking to me about how they're going to get to like 200 gigawatts so much faster and easier than they can in the United States because the energy's already spoken for. And like, the conversation was work for me. So I can't imagine how much the actual reading and the research was effort and work for him. And then after all of that, he couldn't find a viable way to actually invest in it because there's not a direct investment yet. And this person's going to Blackstone to raise the capital they need to actually put the shovels in the dirt. And so you didn't really solve a problem because you're going to end up buying shares of Blackstone at best. Well, I already own shares of Blackstone and I went to sleep on Sunday just fine. So like those are the kinds of things that I see and hear a lot where I'm just like, what's the point? What problem are we solving?
I have a general rule that is not on the outline, so I will be surprising you with this. I think for an average investor, and this is one of the rules I have, is that if there's not a shovel in the dirt, it is uninvestable for a retail person. Like if you're selling an idea where there is not full construction going, usually there is a lot of questions you should ask if they want someone who has a regular amount of money and not Blackstone to invest in the idea.
So pre-revenue is a dirty word to you then?
In some cases, if you want to get scrappy with some biotechs where you're seeing some heavy levels of options activity, let's talk. But I guess that kind of breaks the return on effort idea that you were talking about. But no, there are times where if there are Can I
invest in those biotechs without having to sit on the earnings calls and go to the investor meetings and read the proxy statements to feel like I've actually made an educated guess?
Yeah, it's literally just, does this stock get a lot of options activity? Answer, no. Is there now suddenly a large amount of call option activity? Answer, yes. Okay, maybe worth a speculative stab.
See, I was just about to say that you just described is speculating, place your bet, go handle your business. But
Sure.
I'm talking more about the people that will like get in their cars and drive to the shareholder meeting and listen to every word that the CEO of this micro cap company says publicly. And like, those are more of the behaviors that I'm describing.
I think that is a loss of community. And I've been trying to figure out the way to do this story, but people, as they lose senses of communal identity, one place you can find that is we own this specific stock. And therefore we're in the club together. And the place we meet are at these shareholder meetings and online. And we have a focused topic of conversation. And just join a bowling league. One other piece of financial wisdom that I've heard from a lot of financial advisors is that people should not own gold. And the reason is because it's a pretty piece of metal that just sits there. You can touch it. It's lovely. But as a regular retail investor, you want to be in cash producing assets. I increasingly think that is incorrect. And granted, as we record this, gold is at an all-time high. So I'm not rushing to put all of my money in there. But I think for a lot of people who are a little bit younger, even a little bit older, it makes sense to have an allocation into physical assets like precious metals.
Yeah, you're a bit of a gold bug, so it doesn't surprise me that you've come across this enough to be offended by it. I haven't even seen that wisdom, quote unquote, that you shouldn't own gold, like in financial advisory circles or whatever. Like, I think it's irresponsible to tell anybody that they shouldn't own gold. There's just like it's irresponsible for me to tell anybody they shouldn't own crypto. Like, do I own it personally? No. Do I think there's a case for it? Sure, I could make an argument for why you might want to own it. Do I recommend that any of my clients own it? No. But if they bring it up to me, I don't tell them, absolutely not. That's a curse word.
You are a rare financial advisor who believes both of those things. So I've heard from plenty of financial advisors that Bitcoin is basically a Ponzi scheme. It's all going to collapse at some point. And the theory I had heard on gold from a couple of them, and this is not widespread, but this is something I'd come up with, is that someone would ask about owning gold and they would say, well, do you own any guns? Because if you're in a situation where you need to own gold, then you're going to need to own some guns because it's going to be the end of the world. As if this was the ultimate safe asset, keep it in your keep it in a safe. And it was dismissive. And I think that it is an asset that can protect against inflation in a very long period of time. But more importantly, it is a hedge against the decreasing dominance of the US dollar. And you could make that case both for gold and Bitcoin. And the gold bugs and Bitcoin bugs hate each other. And maybe they just need to get along already.
Well, yeah, I think they see it as more of a binary thing, whereas I see it as a tandem thing.
Yeah.
Like, if you own Bitcoin because you believe it's digital gold, well, then you might as well own physical gold, at least in the form of like GLD in your same brokerage account. Like, if you're going to own iBit, you should own GLD. They go together. Like, not necessarily they go together like as far as their correlation, but they go together in terms of your thinking and your thesis for why you'd want to own them. Because neither one of them actually has a tangible book value. Neither one of them is actually a company that has revenues or earnings or anything else that you could value it based on. It's literally just pegged to whatever people think it's worth at the time. That's what they assign a price to. So they really are cousins. The
other idea that I think is a common piece of financial wisdom that is, in my view, somewhat incorrect is the advice from Peter Lynch that you should not cut your flowers and water the weeds. Meaning, if you see a stock going up, you shouldn't just sell it. And if you see a stock going down, you shouldn't add more money just because the stock is going down. The idea is you want to water your flowers and cut your weeds, add more to the stocks that are winning, and get rid of the stocks that are losing. And that's sort of a simplified way of saying add to your winners, cut your losers. But I think what is interesting about this common piece of financial wisdom is that nobody then goes on to say the next few sentences that Lynch actually wrote in One Up on Wall Street, which is saying that others automatically sell their losers and hold on to their winners, which doesn't work out much better. Both strategies fail because they're tied to the current movement of the stock price as an indicator of the company's fundamental value. A better strategy, it seems to me, is to rotate in and out of stocks depending on what has happened to the price as it relates to the story. End quote. So I'm sure you've heard this before. Don't cut your flowers and don't water your weeds. But what he is actually saying is don't buy or sell a stock just because of what you're seeing in the price movement, which I think is a more accurate reflection of what he was trying to communicate.
I think you're right, but I also think it overcomplicates the sentiment. So I think you get to the same place either way. And I think there's nothing wrong with just the truncated version, don't cut your flowers and water your weeds. Because if you are a person like me, who I need to go raise cash to buy a thing that I'm interested in buying, I have two options. I can either sell the thing that's gone up the most and trim from there because that's where I have gain, so I feel really good about it. Or I can look for the place that has not done well to this point and find the one that I think is less likely to do well going forward, sell that thing, get it out of here as fast as I possibly can to buy the next thing that I think is going to do well. That's typically how I operate when it's time to go buy a new stock and add it to my portfolio. But I don't want to have to go through the trouble of moving in and out of these names on a regular enough basis to try and time it and feel like, okay, NVIDIA's valuation is now 60 times. Its average is 38, so it's time to sell it. And when it gets back down to like 35, then I'll buy it back. And now I'm watering those flowers. I don't have time for that. So it does make sense to say if it comes time that I have to cut, I need to raise cash, I'm going to go buy a car, I'm going to go buy an engagement ring, whatever, I should sell from the companies that have not done as well and keep the ones that have done really well.
However, Lynch makes an important caveat that I think is just as important as the other point, which I don't think is overcomplicated, which is that Lynch is saying if you think there is a broken stock, but a good fundamental business, you should put more money into that company. You shouldn't just pay attention to the price movements of a stock, which is how that advice is often taken, I think.
I see. So, well, I think that's those are two different conversations in the sense that you shouldn't just hold on to companies for the sake of holding on to them once they've proven that story is broken. So maybe to my detriment, sometimes I am very quick to just pull the plug and say, well, that was a terrible idea. And maybe 2 years, 3 years, 4 years later, you can see where the narrative has shifted and things are going back in the right direction and it's doing extremely well. Well, for that 2 or 3 year period, what else could I have done with that money, right? What's the opportunity cost of me waiting for that thing to play out? And so I think there's some truth to that. You could be building a position while the thing is showing pockets of weakness and, what have you, but I don't have the patience, I guess, is the way to.
Sure. Let's wrap with this one. Dividend stocks are for old people.
Yeah, I don't understand this logic. I am very big, especially now when the market has been roaring for the last 3 years on companies that do not pay a dividend or they pay a very minuscule dividend, as it were. I'm thinking about NVIDIA, for example. I'm thinking about Microsoft, for example. I'm thinking about Apple even. Like, these are great growth companies that don't return a ton to shareholders in the form of dividends. But typically, over like a 5 to 10 year period, the companies that show a history of increasing their dividends over time, those dividend aristocrats, are the ones that tend to perform the best long term. And also, in moments of weakness in the market where there's these downturns, they go down less than the others. But when I make that case to clients, they're like, dude, I don't want to own dividends. Those are for my dad. Those are for my granddad. Like and I'm talking about people that are like in their 60s and they're like, that's for old people. I'm not old yet. And I'm like, we're not talking about building a portfolio of like Coca-Cola and McDonald's and we're just going to ride off into the sunset. But we're talking about companies like Goldman Sachs, for example, which pays a very healthy dividend, but has also outperformed a lot of tech companies this year. So that's more the feeling that I have around this. But the feedback that I get from clients of all ages tends to be dividends are for old folks. I want the growth.
I think that's an identity thing. Speaking of identity, one place you can find me is on LinkedIn. I'm Ricky Mulvey on LinkedIn, at RickSoSlick on X. Fortunately or unfortunately, I'm increasingly posting clips of the show on TikTok. You can find me on there, Ricky Mulvey. And one of these days, we'll eventually make an official show thing on there. Malcolm is at Malcolm on Money on various social media platforms. And if there's one thing you take away from this series of plugs, one thing that I want you to take away, is that helping the show is that if you want to help the show, the way you can do that is first of all by subscribing wherever you find it, and then leaving a rating or a comment really helps other people find out about this as we try to get this baby bird off the ground. Thanks for listening. Appreciate you being here.
Information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.